Today, we are delighted to have two wonderful guest speakers to cover important topics. There's been a lot going on in the world. We've always wanted to focus and be proactive on your behalf as our clients and our colleagues and our centers of influence that we work with. So today, we're going to be talking about under the umbrella title, Back to Better. And what does that mean? With all of us going through so many changes personally, the world changing, the economy changing through the pandemic, we really need to come back to the point of how do we make sure that we're getting back to better. There's decisions that people need to make. Maybe you've experienced some challenges personally about having to reset expectations or pivot through some challenging circumstances personally with your family, with your business. And this webinar is about giving you insight and perspective on how to deal with things from the emotional intelligence perspective, but also the economic and financial guidance perspective. Our tagline is Wealth Advisors for Life, and life has been a little crazy over the last year and a half getting through COVID. So we want to give perspective on how to give you practical insight on keep moving forward so that you, your family, your business, your ecosystem, your personal economy is healthy and focused on the next steps. So we're recording this webinar, and if you have others that you want to share this, please let us know, and we'll have a recording available that you can pass on. I want to say thank you for taking your time to be with us today. I know everyone has a busy schedule, and really appreciate. We have an excellent turnout of people, our clients from around the country, and even our guest speakers are in different locations throughout the country. So we're using the virtual experience to bring personal guidance to you in a meaningful way. You'll see on your screen a question and answer box. And if you would like to submit questions along the way, you can do so anonymously. No one will be seeing the questions as they're presented, but they'll come to me and I'll be guiding them and sharing them appropriately with our guest speakers. And for privacy purposes, no one can view you as a guest here looking at our webinar. And we want you to be comfortable and just enjoy the topics that we're covering today. So without further ado, I'd like to welcome our first guest speaker, Patience Schutz. And Patience and I have actually done a number of engagements together in the YPO world. Patience is a creative retreat and workshop facilitator. She's a keynote speaker, a corporate culture catalyst, and a multi-generation communication trainer. She evaluates and explores the world through a psychotherapeutic lens, as her education and background are in the fields of family systems, attachment theory, interpersonal neurobiology, somatic sensing, and conflict resolution. And all of these help her be grounded in the guidance around emotional intelligence. So we're excited that Patience is joining us today. She's a certified forum facilitator for YPO, the largest global community of CEOs, a master trainer for Harvard Business School, alumni forums, a certified trainer with emotional intelligence and diversity institutes, and a consultant for many multinational companies. And her education background is extensive. And Patience, welcome from California, and thank you so much for joining us. And I want to thank you for being the catalyst for our title of the webinar, Back to Better. It was in a conversation with you that we really kind of tuned into the whole topic of being back to better.
Thank you very much, Nathan. I'm excited to be here and appreciate the opportunity to share what I believe are really important life tools. So I'll invite all of you who are on this call to please grab a pen and paper. You'll take notes, or I'll have you contemplate things, and you can also, as Nathan said, put some questions in the Q&A, and we'll respond as we go. It is back to better because the mindset is positive. It's a strength-based thinking pattern, because there has been unrelenting uncertainty for 18 or 19 months. So I'm going to bring a whole bunch of tools to the table to help you balance every aspect of you. So when you think about emotional intelligence, that's where we really start. What is it? EQ means, how do I perceive myself? How do I perceive others? How do I feel? How do others feel? And then what do I do with that information? What choices do I make? How do I engage? in a way that allows me to succeed in ways that perhaps I couldn't have in the past. I want you to think about that as you consider, how are you truly in every aspect of you? Just take a moment, and on that piece of paper, how are you really emotionally, physically, spiritually, and mentally? Maybe just one or two words for each one. Maybe emotionally you're fatigued, but physically you feel excited and confident, etc. So just take a moment, because that first space of EQ is self-curiosity. What is happening for me? How am I? Jot those down. I'm also going to have you now reflect on the last 6 months of your life. What's something you've learned that perhaps you wouldn't have learned if COVID had not happened? What's something that you will no longer return to that's a positive change in your life because of COVID? Or what's something you're going to continue doing as a result? So as you think about how you have navigated this time of unrelenting uncertainty, what's the impact on you? Here's what they truly are. They're chemicals, and they're chemicals that drive behavior. Emotions are neuropeptides, hormones, serotonin, oxytocin, neurotransmitters, and they're what happens before our brain actually has a moment to make sense of things. It's our reptilian brain at work. And when we feel the sensation, we have an awareness of it, then we label it a feeling. And emotions drive behavior always. And if you lead with emotions in your relationships, you have a better chance of driving empathy in your listener. So the more data points around emotions and feelings that you can offer your listener, the better that you will have in creating a deeper connection. This is research out of Finland from 2013. And the researchers put 800 people into MRI scans and had them think about areas of their life where they were sad or surprised or anxious, had them recall moments. And they compiled all the data. And this is where you can see the research landed. And the colors are around intensity. So when you think about feeling anger, you can see that it's mostly correlated to your chest, your head, your arms, your hands. If you think about shame, it's focused on eyes. And if you feel guilty, it's your own self-judgment. Shame is how you perceive others judge you. So of course you would be focused on how, looking outward, you are seen by others. So when you think about how you're feeling, it's also important to recognize that feelings are all over. They're all over your body, and the intensity is what drives your understanding of what's happening. As we move through our emotional states, this is truly the three that we want to focus on. Hyperarousal, that's when I'm overwhelmed. Maybe I've had a financial setback, or COVID has created financial uncertainty in my portfolio, or my children are struggling financially, and I begin to feel overwhelmed. It's hard for me to shut down my brain at night. I'm in hyperarousal. Or maybe I become numb and quiet and distanced. Then maybe I'm in hypoarousal. I'm really checking out. I'm really pulling back from engagement. The opportune time to have conversation with yourself and others is in that window of tolerance. And the reason is our vagus nerve is always scanning for danger, and it's always in fight, flight, freeze, faint. So our vagus nerve releases those chemicals, they flood our body, and then it's our job to navigate what's happening and then move forward from there. These are the cycle of emotions. We feel, we have the chemical cascade, we then feel, then we have thoughts, which we can create in positive ways. Then that moves to behavior and to consequences. So that's a whole bunch of information, but it's where we always begin with tools for life, which are how am I, how are others? So I've got another moving piece here is what's true is that in the last 18 months, there has been a rise in internal conflict and conflict with others. as a natural consequence of all of the unrelenting stress. And when we're stressed, our body releases cortisol consistently. So we're not at our best in any way. When we think about conflict, I want you to think about conflict for just a moment. I'm going to show you the different styles of conflict. We often consider one or two ways, but there's really a number of ways. One is we flee, we leave, somebody might say conflict avoidant. If we force or fight, that means we lean in and we want to, get in there and get gritty. But often that doesn't have a positive outcome because we come with anger rather than curiosity. 50-50 response means I have to give up 50% of my needs or wants or desires. And my expectation is that you will give up 50%, which is not optimal either. Fold means I relinquish all my needs to you. If you think of someone who's bullied, they just hand over their lunch basket, right? But co-create means this is a new future-focused way to consider conflict. Future-focused means I'm going to think about what I feel, what I need, what my thoughts are, share them with you, and we will find a co-created new future-focused outcome on things we can agree on. So I want you to think about how you have navigated conflict this last 18 months with yourself, those elephants inside, or how you might have navigated conflict in your company or your family or your marriage or even friendships or in your community. What style of conflict are you most likely to use? So how can I help you find those tools or give you tools to have all of you co-create in a very different way? Because conflict resolution is not something we learn ever in school. We don't have classes on tools for life, tools for resilience, etc., empathic listening. We don't have those options. And then we get into adulthood and it's really difficult to navigate them. So my goal is to give you some tools here. I want to share a visual that really captures our life goal, which is when you think about conflict, we're wired to connect, and it's our self-imposed armor that keeps us separate. Though that armor could be our unhealed wounds, our shadow selves, our unmet needs from other places that we put on others. But at the core, humans are surviving because we're wired to connect. So this is just a beautiful visual. It comes from Burning Man 2014, a Polish artist did this installation. I'm going to stop sharing here. And I want you to think for just a moment. Close your eyes and contemplate. What makes relationships healthy? How do I know if my marriage, my family, my firm, my friendships, are they healthy? Am I healthy? What does that really even mean? What's that question? And I want you to think for just a moment. On your paper, you can jot down a few words. What are attributes of healthy relationships? What are critical behaviors and essential ways that we behave when they're healthy? Because most people actually don't know how to assess where am I struggling and what can I celebrate that's working well in my relationships. But there really is a tool for how we would assess that. And what's also true is that relationships that are healthy have hills and valleys. And in intimate relationships, what's healthy is occasional conflict. It's not normal to be in an intimate relationship and never have conflict. What's normal is that there's conflict and it's resolved, because that drives intimacy and safety and trust, knowing that I can have a courageous conversation and there's no fear of imploding the relationship. And that's what that really looks like. It is a tool, however, to navigate those hills and valleys. I'm not going to spend a ton of time into the specifics, but just know that the most important two pieces of these steps are the first two. If you tell somebody how they matter to you, it allows their vagus nerve to listen, to be calm and neutral. So it might sound like this. You're my spouse, you mean everything to me. You're my child, I love you. You're my employee, you're my coworker, I care about you. If you tell someone that, it allows them to be present to you. And then you lead with feelings. I feel sad, disappointed, overwhelmed, concerned, etc. And then you just follow those little steps. I believe you'll get these slides or variations of these slides. So you'll have these tools for your own hills and valleys. And the other piece is how to listen. So one part is I share, but the other part is how do I receive? And it really means I'm listening with my whole body. I listen with my ears, my eyes, my nose, my everything. And I listen to understand how you feel, what you need. Right? Those are the real key pieces here when I think about relationship health, how I navigate conflict, trying to get to that co-created outcome. And it happens because I feel what you feel. I understand your reality and I stand in your reality. Doesn't mean I have the same perspective, but it means I feel what you feel and I understand and I convey my validation of that understanding to you. So that's just a very broad stroke to that. But I want to now move to the tools because I've covered EQ, some navigation of conflicts, what a healthy system is, what a healthy family or firm is. And then what are those tools when things aren't going well? What can we do here? The first and most critical one is pausing in stillness. It will take 4 seconds. When we allow our breath to slow, it allows our nervous system to catch up. When we're stressed, our prefrontal cortex is overwhelmed. And through breath, we allow that oxygen back in and we regulate our body space, which allows the stress and our chemical reaction to change. So breath is the first and important tool. The other option is grounding yourself in the present. And it looks like this. It's grabbing all your senses and pausing. What can you see? Just name 5 things in your mind. What can you feel? Your clothes, your computer mouse, your pen, your hair, your hand. You know, what are you feeling? What can you hear? Is there background noise, construction, children in the house, somebody on their computer? What can you smell and what can you taste? Even if you just did 1 for each of your senses and took 5 seconds, it causes your body to be in the present, which allows that chemical shift in your body. And that is a real tool to use. We went over breathing. The other important pieces are movement, music, stillness, and actually engaging your body in ways that perhaps you hadn't considered. Movement and music actually change your brain waves. So if you're feeling stressed, it's helpful to get up and walk. It's really great if you can put a headset on or just put music on in the background. If you're in a family office with your coworkers being family members, having background music playing is a great stress reducer because your brain waves are shifting through that music. What else is true is hugs help. When our bodies have physical skin-to-skin connection, our body releases oxytocin and serotonin within 18 seconds. So very quickly, our bodies and our stress response changes. It's also true that if we're in conflict or having some avoiding behavior and we touch someone, not like this where it's on material, but actually skin to skin, it allows us to co-regulate our bodies and both of us be in the same emotional state. And then lastly, hugs truly help, but more importantly, hope. Hope, that mindset, those really clear ways to think, like if I have hope that things can get better, they will. And it's also true that hope is a great motivator. I am certain that COVID's going to end. I am certain that we're back to better, that it allowed the whole world to reset how we are, who we are, and to really co-create a very different, better future. And then the last thing we'll end before we have some Q&A here. If success were guaranteed, having all these tools that I just gave you, what one bold step could you take, or what important change could you make to create a very important outcome in the future for yourself using some of these tools or rethinking about things differently? Or what's a personal insight that you've had today that you learned about you that you didn't know before when we first started the call? And there's a little visual on that slide about opening your heart space. What's also true is sharing that vulnerable heart space with someone else really does help you move closer to those positive outcomes. So we'll stop there and open it for Q&A. If we have any wonderful, I'll answer them live, or if you put some questions in the chat later in the call, I'll stay on the call and we'll have time at the very end. So thank you very much. That was a lot of material distilled down into 25 minutes or 22 minutes.
Thank you, Patience. That was excellent. I found myself just feeling more relaxed the more that you spoke. So your input and guidance was so helpful, and a lot of great takeaways. There's a couple questions that arose. A lot goes on in the world with headlines and media headlines and kind of the stimulus that's always happening. And question is, in my mind, I feel like I'm constantly turned on to process things. Like I'm trying to navigate what the issues are and how do I slow my mind down, or how do I turn it off? I feel like I'm kind of plugged in and I need to unplug.
Okay, that's a great question. And that speaks to someone's high EQ, that they actually are aware this is a challenge for them and it's an opportunity. A couple of things you can do. You can touch your own body, head to heart. You can put your hands together. You can cross meridian. So that means left side to right side. You can even do it sitting at your desk. You're watching the news. You put your right hand on your left leg and, right or left hand on left leg. You can cross your hands. Anything that crosses the meridian changes your brain waves. You can create a little mental mantra for yourself. I'm okay. The world's okay. Things will get better. Things are getting better. Life is better. So you can create a thought that will also shift your brain waves. You can turn the news off. You can close that app and then close them out in your mind. Just close all those apps down mentally. And then movement and music, jump up and down, take a walk around, or just truly going into stillness, back to those five senses and back to the breath.
Thank you. Another question, and this is a topic that we cover with our clients in discussing money with other family members. And sometimes that creates conflict. Sometimes that is a big hurdle conversation. Any takeaways around how to approach the topic of finances with other people or family members?
I used to call them taboo topics, those topics that are really hard to have with the next generation. But at the end of the day, I realize they're not taboo topics. They're critical and important topics. And they're important topics to cover long before they become an issue. So how to start? It goes back to EQ. How do you feel leading your sentences with a feeling word? I'm feeling nervous to have this conversation with you because we haven't had it before. Or I'm feeling excited to talk about finances, or what happens when I die, or what are my wishes for my funeral. Like those are critical topics to be having, but you'd start with feelings. I'm feeling, there's a blank, fill in the feeling word, and then share your desire, your wish, your need. I really want all of us to share candidly, or I hope that we have a very different outcome than I would have had in my own family. So it goes back to those perspective sharing steps, those 8 steps.
Thank you. So helpful. I want to thank you for your contribution to our webinar today. The whole area of emotional intelligence is something that really needs to be elevated and have a greater spotlight on, because it's who we are. And we need to continue to be self-aware, have empathy with others, and keep moving forward so that we do get back to better, and it will happen quickly. So thank you, Patience.
Welcome.
I am delighted to introduce our next guest speaker, Jeffrey Kleintop. Jeff is no stranger to the Planning Alternatives webinar cadence here. Jeff is the Managing Director and Chief Global Strategist at Charles Schwab. He's responsible for analyzing and discussing international markets, trends, events, really focused on helping investors understand what's going on in the world. He provides research, commentary, and actual insights to Schwab's teams and investor services and our clients. So Jeff does a great job given his extensive background, educational background, and his media appearances. You've probably seen him on CNBC and Bloomberg, Wall Street Journal, Barron's. But he takes data and he packages it so it's understandable. And there's so many moving parts going on in the world today that we're delighted to have Jeff join us. Welcome, Jeff. And
thank you so much, Nathan. I'm super thrilled to be here. Always thrilled to be with Planning Alternatives. I don't know if you all know this, tuned into this broadcast, but look, Planning Alternatives is one of the best firms in the country that works with you on your financial future. I don't know if you're aware that you've made such a great choice, but I don't do this for just anybody. But frequently, Schwab takes a look at who are the best of the best, and Planning Alternatives is always very near the top of that list, if not at the top. So I am thrilled to be here. I expect brilliant questions from all of you, not to be intimidating. Feel free to get those questions in, and Nathan and I will have a lot to talk about at the end of my prepared remarks here, which is really going to focus on how Mr. Market is really emotional right now. Yeah, going through a lot of emotions at the moment, all those chemicals kicking in. September and October come with a history of market volatility. Markets may, again this fall, they've already kind of started to opt to focus on near-term growth worries related to COVID-19, central bank tapering, that's where they buy fewer bonds, providing less liquidity and money and support to the markets. A potential corporate default in China, which got a lot of attention on Monday, but might happen tomorrow. There were elections all over the world this month. We've got Canada, Russia, Germany, Japan. I mean, a lot of major economies going through new leadership changes. We've got worsening supply chain problems, but all of that despite a really, I think, favorable economic environment for 2022. Look, we've got global COVID case counts have begun to recede again, but now there's some ambiguity around approval for booster doses, and that could trigger some investor concern over potential for another rise in cases, maybe this winter, along with sort of the seasonal rise in flu cases. We've got shipping log jams back. They're at the worst levels of the pandemic, and that creates more risks to earnings and inflation here as we get close to the earnings reporting season. The European Central Bank announced it's going to taper its asset purchases, although I don't think tapering is going to make much of a difference to financing conditions. Oh, and by the way, at 2 o'clock today, the Fed could, we don't think they will, but they could announce a similar thing. Stock markets are just conditioned to react to changes in central bank actions. So could see some volatility there. And finally, this Evergrande that I hinted at, this Chinese company that could default, it's the world's most indebted property developer. It's among the most highly leveraged companies in China. It's recently been struggling to make its debt obligations amid some regulatory changes. And that leaves investors worried about the potential impact of a default. But again, looking beyond the next few months, we believe that the 2022 global economic environment may be very favorable for investors. So let me show you a little bit of what I want to cover here today. I always feel like charts are worth 1,000 words. So this will save some words and hopefully convey the thoughts. I want to, as I indicated, I want to start here with where we are in the economic backdrop for this path from recovery. We're not in a recovery anymore. We're in an expansion now, and I'll talk about what that means. I want to talk about the Delta variant, biggest risk, I think, and COVID in general as we look out over the next several months and year. I want to talk about this lockdown leadership that the market has been stuck in. We are back to the areas of the market that are doing the best are the ones that did best during the pandemic lockdowns. Does that make sense? Or should we be more focused on reopening stocks and economically sensitive equities? I want to talk about that. Then I want to talk about inflation, which is also a very hot topic, and kind of wrap it all up with maybe how to think about investing here over the next several months and even a year or two. So let me start off with the fact that we're not in a recovery anymore. And that's probably news to a lot of people, maybe including politicians. This is a very simple chart. The blue line is global economic output. It's kind of the way we measure everything that we do in the world and its value. It's measured in trillions of US dollars, but this is literally all the output of the world measured. And you can see that prior peak back in 2019, then the very sharp and deep, painful recession, and the very equally rapid recovery, and where we are now as of the end of the second quarter. Don't have third quarter data yet, it's not over. But as of the end of the second quarter, global economic output had fully recovered. Now, that doesn't mean every country or business or family is back to where they were, but overall, we're back. You can't call this a recovery anymore or talk about the need for emergency stimulus. I mean, sure, there are parts of the labor market that haven't fully recovered. Some areas aren't all the way back, as I mentioned, but by and large, we are in an expansion now. And that usually means we move from an environment where the stocks that are doing the best aren't just the ones that are rebounding because they fell the most, but we're now in an environment of new growth, which usually means more economically sensitive companies tend to perform the best in the markets. That is what we've seen this summer. I want to talk a little bit more about that. But let me put this in context for a second, because that V looks really deep and the rebound looks really sharp, but we're all kind of aware of why and what happened. Let me put it in some historical context. This is the economic growth rate. So the growth rate in those trillions of dollars, what are we adding or subtracting each year to the global economy? And our eyes are drawn to the end of this chart naturally, the huge drop in 2020. Yeah, the worst recession in more than 50 years. And then the sharpest recovery this year. In fact, if we see 6% growth this year, that's the International Monetary Fund's forecast. They forecast global economic growth along with a number of other big think tanks. 6%, I think, is a realistic number. But look, when was the last time we saw 6% growth? 1973. I don't know how we measure generations anymore. Is that one generation, or is that like millennials and Gen X and Gen Z? If you throw it all in there, maybe it's 3 generations. Suffices to say, really strong economic growth. Next year's forecasted to be just below 5% by the OECD, by the IMF, by the World Bank, by everybody who does these global forecasts. Back-to-back years of growth above 4% are very rare, right? We saw one there in the middle 2000s, but you really kind of got to go back to the early 70s, right? 1973, 1972, 74, to see an environment where you saw growth this strong. So just, we're all aware of the recovery, but it's the strongest recovery we've seen in a few generations. Really strong back-to-back years of economic growth this year and next year. This is the rising tide that I want you to think about. There are waves of worry, and there are gonna be waves of worry over the course of the next year. There always are. But this is a rising tide, and quite different than what we saw in the last economic cycle, where markets didn't perform as well and economic growth was pretty lackluster. We had a lot of waves of worry from 2009 to 2019. Economic growth was pretty lackluster. Now that rising tide of growth really, I think, helps to float a lot of boats here and helps them overcome those waves of worry and volatility. But that said, let me talk about some of those and kind of maybe hopefully put them in context to some degree. So the Delta variant we know is probably the biggest risk as we look out over the course of the remainder of this year and into next year as well. This is the number of vaccinations. You've probably seen this chart in various forms, but this is the number of vaccinations on a daily basis. They've peaked out at different times in different countries. The UK was the first to hit 50% vaccination within their borders, and therefore the kind of the rate of vaccination slowed first, followed quickly by the US. Now France, China, Canada, quite a few other countries have peaked out. The vaccination rate's coming down, but it continues. The important thing is, what is the effect of having a vaccination rate now, for example, in Europe at about 70%? What does that mean when we get another breakout in cases? So I'm going to point you to this chart. This is the UK. The UK was the first to really see the Delta variant really begin to pick up early this summer. But look at this. So this is cases and deaths. Now, usually they track together, obviously on different scales, right? So here, the orange line is the number of deaths. That's on the left scale. The blue line is the number of cases on the right scale. And I just shifted deaths back 15 days because that's usually the lag between the documented case, usually in the hospital, and then the ultimate mortality. So they tend to track each other very, very closely, and did prior to these vaccinations back at the beginning of this year and late last year. But look what's happened with the Delta wave. Thanks to those vaccinations, which admittedly are slowing, and we should focus on that. But look at what happened, a huge surge in the number of cases, but very little in terms of death. The latest data, 96 deaths. Every death is a human tragedy and an immeasurable loss. But if deaths were tracking the normal case, we'd be seeing 750, 800 deaths, and we'd likely see economic restrictions put back in place in the UK. But the UK dropped all their economic restrictions this summer, didn't increase them. And there was a lot of controversy as to whether that was the right thing to do, as the number of cases soared, yet the Johnson administration opened theaters, opened pubs, opened sporting venues, and deaths and hospitalizations remain very contained. This means that the economic impact of further breakouts may be fairly minor. And the human death toll may be very minor as well. Politicians responding to that, obviously. And so this is important. We may see some emotion tied to these rising cases that we may see going forward. But as long as the deaths remain contained, and I don't know if they will, hopefully the vaccines and eventual booster shots may remain effective against any additional variants. And we've got a large portion of the world in Africa, parts of India, Latin America, that remain unvaccinated and remain a factory for new variants. And those variants could become more deadly and not be effective with the vaccine. But hopefully they will be. I think this is a risk. You're going to see it come up and down in the markets, but I think it's one. I don't think this wave, the next coming wave, whatever it's going to be, of COVID cases is going to be enough to overcome that rising tide of global economic growth. Okay, enough on that. But what's the market doing? The market is reacting as if we are headed into lockdowns. Let me show you. This is the most complicated chart I'm going to show you, but it's probably the most important one in understanding everything that's happened in the market this year and everything that might happen over the remainder of this year and into next year as well. So I'm going to take a few minutes on it. It's worth the investment. Stay with me. Top line is the number of daily global COVID cases, right? So this year it came down, back up, down, and then this latest Delta wave is now seemingly rolling back over. Below it, seeming in a very similar pattern, is the performance of different parts of the stock market, the difference between defensive stocks, lockdown leaders, those do well in the work from home environment, versus the reopening economically sensitive stocks. Easiest one to explain this is the blue line. The blue line is tech stocks versus energy stocks. So all this technology that we needed to work from home and live from home and play from home, internet retailers and all these social media companies and technology companies buying so many PCs and everything in order to facilitate this environment did do very well when we're seeing the case count climb, right? So when that line goes up, the blue line goes up because tech stocks are outperforming energy stocks. Energy stocks are the clear beneficiary of a reopening, the return to travel, right? People getting back on the road, back in airplanes, traveling around the world, more goods demand, that type of thing. So when the COVID case count comes down, tech stocks underperform energy stocks, right? And when the case count goes back up, energy stocks are outperforming tech stocks. And that has been pretty consistent here. And we're starting to see that begin to roll over, right? As the case count begins to come down, we're seeing a rotation out of tech back into energy. That may continue. If history's any guide, that may continue for the next couple of months. Hopeful we don't see another wave. I don't know. Hopefully we don't see another wave and that continues for more than just the next couple of months. But I think it'll explain the rotation back into economically sensitive sectors. And that matters between growth and value. We often divide the stock market into growth stocks and value stocks. Value stocks are cheap but economically sensitive, and growth stocks are pretty expensive, but they tend to have secular growth drivers. Like, for example, the tech sector. And of course, a classic value stock would be the energy stocks or financial stocks or industrial stocks, right? Same things happen there. So as we see the case count rise, we see growth stocks outperform. They're more defensive, right? Because what are growth stocks? Tech and healthcare. And then when we start to see the case count come down, value stocks tend to outperform, right? Like energy and industrials and financials. And that pattern's been pretty consistent this year. And then also US versus international stocks. When the case count's going up, US stocks outperform. Why? Well, the US stock market is dominated by growth stocks. Tech and energy are the biggest sectors in the US. And when we see the case count come back down, we see a rotation back to international stocks. What are the biggest international sectors? Financials, industrials, energy, the value parts of the market. I think this explains everything that's happened this year. It explains why it's been a struggle to see any particular area break out. There's a lot of talk at the beginning of this year about how international stocks or value stocks, which have been beaten down for so long, really deserve to come back. But it's been frustrating to see them struggle to do so. We're about to see, I think, a rotation back into them, but it's all kind of been explained by this overall ebb and flow in the number of cases. So as that comes down into the fall months here, hopefully we see that rotation back to growth, back to sectors like energy, and back to international equities over the remainder of this year. And hopefully into next year if we don't see another surge in cases. But I think, again, really important in understanding this year's behavior in the markets. Now, the point of this isn't to say, well, let's just buy a whole bunch of international value stocks and put all our money in energy. Because this year we've seen new highs in all these areas. In the S&P 500, we've seen new highs this month. In Europe, we've seen new highs in the last month or so. In growth stocks, new highs. In value stocks, in new highs. They're just making new highs at different times. This is great. In fact, this is the only free lunch when it comes to investing. When you've got stocks zigging and zagging in your portfolio on their way to new highs every other month, but moving in opposition to each other, we get the real benefits of diversification so that the overall volatility in our portfolio is relatively low as we kind of climb towards our financial goals. This is a beautiful thing, and it results in a chart that looks like this. Quick explainer, this is the correlation in the stock market. So when correlations are high, stocks tend to move together, right? On a typical day, you might see the S&P 500 and international stocks move up or down in sync with each other. What we've seen recently is they've moved out of sync with each other. On a day that US stocks are up, international stocks might be down. And international stocks up, US stocks might be down. And you get the benefit of this negative correlation, which is a positive to your portfolio as they move, kind of out of sync with each other, but both on their way to new all-time highs, which they continue to do every other month or so. So this is really important. That's why diversification, growth and value, all kinds of different sectors, international and US equities, really paying off in portfolios this year, despite the fact that it seems to be a struggle for leadership. It's not confusing. It makes a lot of sense. And that value of diversification really paying off. So let me wrap up with a few other things here. I want to talk about inflation, probably most importantly, and then conclude with some other investment takeaways. Inflation's really been breaking out in the US. You can see it here. The blue line is US core inflation, which just strips out energy because it tends to be a little volatile. And orange is Europe, and green is Japan. Green, look at it, it's negative. Inflation in Japan is negative right now and well below where they'd like to see it. In Europe, it's a little over 1%, but not really outside of much outside of the range of the last 5 years. It's really only in the US that we've seen a real surge in inflation. And a lot of that has to do with the supply chain bottlenecks that we've been experiencing and prices of goods coming out of China. In fact, so much so, I think this explains a lot of the inflation we've seen in the US and where it might be headed over the next few months. This is good news. The blue line in this chart are prices of goods coming out of China. The orange line are prices consumers are paying in the US. I mean, it's a little bit of an oversimplification to say we just have to look at what China's selling to us and figure out that's what our inflation is going to be a few months later. But it seems to work pretty darn well. And what it's pointing to is US inflation coming down over the next several months to that maybe 2 to 3% comfort zone of the Federal Reserve. As we get into the fall here and get closer to the Fed announcing that they may begin to pull back emergency stimulus measures, but not too aggressively because I think inflation's probably going to subside right along with that. So keep a close eye on this. But I think this is really important. But therefore, I'm not overly worried about inflation. Inflation, I think, is going to be higher than it was in the last economic cycle from 09 to 19, 2009 to 2019, but not runaway. Not something we need to be overly concerned about as investors. A little bit of inflation is healthy. We were often worried about inflation being too low from 2009 to 2019, kind of back in the sweet spot for inflation, we believe, given a lot of the structural reasons for that and cyclical reasons as well. So I wouldn't get too concerned about inflation. I know we've got a big fiscal spending package that may probably be coming through here in the next few months. So does Europe, so does Japan. But don't think it's going to be a huge driver of above average inflation. I think it's well within the range that the Fed would like to see it. But that doesn't mean these supply chain issues aren't causing problems, even if that problem isn't inflation. So if you take a look here, this is a map of San Pedro Bay, which is right outside the busiest port in the US, which is the port of Los Angeles and Long Beach. This is the 7th busiest port in the world. The other busier 6 ports are all in China. Early this year, we had a lot of backups, a lot of ships waiting to unload in San Pedro Bay, over 40. We got down to less than 10 as of June 26. These are pictures I snap. I look at this every single day. I check all port traffic around the world as part of what I do. By August 26th, we were back to 40 ships again. As of today, we're at about 60 ships. It's just gotten worse and worse and worse. Shipping problems had improved, but now they are back to the worst levels of this year, back to the worst levels of the pandemic. Right now in the port of Los Angeles, arriving container ships have to wait about 20 days to get an available berth to unload. Now, it only takes 14 days to get all the way from Shanghai to Los Angeles, the most popular route. So that's a long time to wait when it comes to delivery speed, not to mention the delays, unloading at berth, and then sitting at port waiting for a truck chassis to put them on and get them on their way. This is usually the peak week of the year for shipping, but the backlog is so big, this is likely to be with us a bit longer. Now, we know the idled ships and containers have put upward pressure on shipping costs as shipping capacities become constrained. We've got containers and ships just sitting around waiting. The spot rate for a 40-foot shipping container from Shanghai to LA, if you want to book one, has risen to $12,500 from just $3,500 a year ago. But that isn't the worst of it. I know it looks like inflation, but I think the real problem is in the potential for missing sales or production targets rather than higher cost of goods sold. Let me give you an example. A 40-foot standard container unit will hold 20,000 pairs of jeans. I know this is talking to the apparel industry. So the increased cost of $9,000 per container, it's like 45 cents a pair. Now, if jeans are sold for $50 a pair, my wife tells me you'll never find a pair of jeans for $50 a pair, but whatever, let's say they are, then it's less than 1% inflation if it was passed on in its entirety. But if those jeans aren't on shelves for the holidays due to delays, then the revenue just doesn't happen. And that's probably the bigger risk right now. Now, we're tracking how many businesses in different regions are indicating they're having material problems with their supply chain. It's soaring in the US and the UK and Japan, the same places where supplier delivery times are deteriorating, but not so much in Europe. In Germany and France, this is a chart of the number of companies in the index that are saying they're having really significant supply chain problems. Europe could be a place to hide out here if there are some potential disappointments as we get into the earnings season from companies that just can't hit their targets. They couldn't get products delivered. Okay, real quick, let me wrap up with just some investing takeaways. This is a year that we felt Europe would outperform the US, really past that leadership after a decade or even 12 years of US market outperformance. Slight, barely, and I think just based on the chart here, you see tiny 0.2% maybe outperformance by Europe. I think we'll see more of a rotation here as we see that case count fall, and again a rotation to value and international stocks over the remainder of the year. So I'm still holding to that view that should play out. We have a number of reasons to believe that earnings growth is going to be at least as good outside the US as it's been inside the US for the first time in a long time, looking at about a 55% increase in earnings to next year from the pandemic low year of 2020, both in the US and outside the US. And valuations are very different. So the price to earnings ratio, the price we pay for a stock, way, way lower in Europe, the orange line here, that is in the US. In fact, the widest gap we've seen in more than 20 years, actually the widest gap we've ever seen in history between companies really in the same industry, what you'd pay for a company in Europe for the same earnings growth versus one in the US. So a lot of factors, I think, playing into this rotation into international equities over the remainder of this year and into next year as well. So let me just wrap that up. I just want to say the recovery's over. The expansion, though, continues, and that's great news for economically sensitive companies. I don't think we're likely to see runaway inflation here. That risk appears to be fading, but I do worry about the sales and earnings risk associated with these supply chain problems. COVID-19 is still the biggest risk. Can't put it out of our minds. We've got to focus on that. But this lockdown era leadership may soon rotate into more cyclical, economically sensitive leadership. And don't forget, we are seeing the strongest economic environment we've seen in generations. And that is a very important rising tide as we look out to next year, Nathan. So I'll wrap it up there and look forward to talking with you and see what's on everyone's minds.
Fantastic overview. Taking a lot of concepts, a lot of data, and distilling it into something that's very helpful, very practical. It so aligns with our message and our philosophy around risk management and portfolios, in that we diversify, we spread out the assets, we manage the risk tolerance, we align objectives to our clients' financial plan and goals, and monitor that along the way. So thank you for sharing your insight. A couple of questions arose. No surprise, but in the US, we are experiencing extraordinary government spending. And what are your anticipated consequences of that? On one hand, there's a lot of concern that may dilute our ability to recover, that there's a price to pay at some point, there's a day of reckoning. How do you interpret what's going on in Washington as it translates to the economy?
Well, clearly there's a lot of effort on both sides to shape what this will ultimately look like, both in terms of the spending priorities and the tax increases. I don't know what it's going to look like yet, so it's hard to say what the outcome's going to be. We've got a lot of folks in Washington that are, on the beat and helping us try to understand everything that's going to happen. Certainly, we're likely to see that additional spending come through. A lot of it, earmarked towards, social programs. That money tends to go in fairly quickly when implemented and tends to be a boost. The cost of this, the market's well aware of it, right? It's not a secret. We haven't seen bond yields move all that much. There's tremendous demand for treasuries out there, and that continues. So we really haven't seen a huge uptick in borrowing costs. And that's usually the arbiter of how much spending gets done. When borrowing costs go up, you got to pull back a little bit. We just haven't seen that. That could be yet to come, but we don't think so. We actually think yields are headed higher over the remainder of this year. We could see maybe 1.75, 2% on the 10-year yield by the end of the year, but we don't think that just continues to 3%, the following year, or 4% the year after. A number of reasons why we think yields will remain fairly contained. And that as a result, all of that debt is, relatively affordable. It's the biggest risk is inflation. It's not so much how much debt you have, it's how much you're paying to service that debt. And so, look at Japan. Japan has way more debt in their economy relative to the size of their economy than the US does, multiples of it. But where are interest rates in Japan, right? They're zero, negative in some cases. Well, you can have a lot of debt if you're paying a negative interest rate on it. So it really comes down to what that interest rate is in terms of the cost of servicing the debt. And that our outlook is that that'll still remain fairly low.
Thank you. Another question around taxation. And I know there's a distinction between the taxation of a consumer versus what the economic factors are and what moves the economy and markets forward. But what do you see, if any, correlation to increased taxation in the financial markets?
Well, the markets are sensitive to corporate tax rates, more so than individual tax rates or capital gains rates. So when you take a look at some of those industries that benefited from the corporate tax rate reductions during the Trump administration, they were largely domestically focused industries, didn't have a lot of overseas sales. So you look at the utility sector or financials or some of those areas, and they may be as a result, they may see, some negative impact to their after-tax income. I think the interesting thing is what may happen with the tech sector. This is a sector that's been able to keep its effective tax rate very, very low, but there are increasing efforts both within the US and around the world to address that, where they house their intellectual property assets that generate a lot of revenue are in some cases in zero tax jurisdictions around the world, or areas that may only tax them at 10%. So if that were to, if the world were to put in this global minimum tax rate that's currently being kind of moving through the G20 and headed to the OECD, you could see a material increase in the tech sector earnings, which is something they haven't seen in a very long time. But let me say that the trend for corporate tax rates in every major country around the world has been down for decades. Very hard to turn that around in a material way. So I think ultimately, while US corporate profits or corporate tax rates may bounce a little bit, the US is now kind of in the middle of the pack globally, and really hard to push it above that. There's just a lot of resistance to that from a corporate standpoint. So I don't think this is going to be a big material move. They may move back up a little bit, probably not up as high as they were. The US was kind of catching up to the rest of the world with those corporate tax cuts. So a little bit of a rebound, essentially slightly negative news for some of those sectors, maybe particularly financials, but not as positive, not as negative as it was positive when they were cut, meaning that the impact is maybe not as significant looking at the relative rate that's likely to take place. It's more that tech sector that's the potential surprise for investors who've been really focused on just incredible growth in earnings there. And the risk there that they could see a whole new regulatory and legislative regime as we move forward.
Thank you. And final question on your content around the Federal Reserve. So what is the Federal Reserve trying to balance right now? And what do you anticipate? What should we be looking for as investors to come out of the Federal Reserve's actions?
Well, they're trying to take back the emergency stimulus that was provided during the pandemic. So there's a certain amount of support for the economy that they'd like to see remain in place as they slowly begin to remove it. But as I noted, we're fully recovered as both in the US and globally. And we're in a new expansion, and global economic growth both this year and next year is supposed to be the strongest in 50 years. So it's probably time to begin to pull back on some of those emergency measures. But if they do so too quickly, that it can reverse a lot of the efforts that they've so painstakingly and costly put in place. So they're trying to kind of wean the market off of this stimulus in a very slow way while keeping rates from spiking in a way. Just real quickly, back in 2013, when they attempted to do this coming out of the great financial crisis, years later, but attempted to begin to pull back, yields suddenly spiked. They doubled. They went 1.5% to 3% in a very short amount of time. And that forced the Fed to backtrack and reverse course. They don't want to have to do that again. So a very gradual pace of beginning to slow their bond purchases, allowing bond yields to rise a little bit is what they want to see. They don't want to see any abrupt movements in the markets that could shake up corporate investment plans. Thank you.
So I'd like to just join us all together again, if we could bring patients back online as well, who are patients. My final question for each of you is, what are your final takeaways? So what would you, in closing, share with our audience members today as takeaways from each of your topics? And I'll ask patients for your input, please, first.
Thank you. My takeaway is that from my window, I can see all the container ships, and my husband, we own a toy company, so all of our product for the holidays already should have been offloaded, but they're sitting there. So my takeaway is I need to use my own tools, which is to stay calm and move into a positive mindset, and probably come up with a backup plan for our own family's financial quarter, because there are things outside of our control. So my big takeaway is use my own tools for life, because I want to be back to better as well.
Great reminder, good self-reflection. Jeff, takeaways, things to pass on?
Yeah, I like that. I think it's that, remember, there's that longer term rising tide of global economic growth that I think is going to float us over these waves of worry that are going to hit us over the next several months. I know it's hard to turn your attention away from the steady news flow. And look, I know what gets clicks and we know what gets viewers, right? It's the stressful news. But I think there's a lot of positives here in the backdrop that are going to be with us here over the course of the next year. And I think that allows us to deep breath and get centered and not focus too much on those risks. There'll be a time to focus on those risks again, but it's probably not here over the course of the next 12 months.
Thank you both. Those are excellent takeaways. And thank you so much for sharing your expertise. This is our first time that we brought two expert speakers together to share kind of the emotional perspective of navigating life with the economic perspective of navigating what's ahead. So really appreciate both of you. We're here as Planning Alternatives and your wealth advisors to guide you every step of the way. There's always change, and we embrace the change that you experience in life every step with you. So we'll be sending out a survey after today's webinar and ask for your feedback on what you valued, what you would like more information on. As I mentioned, we are recording this, so we'll have various resources available for you. Speaking of resources, I just want to make a quick mention as we wrap up about our new website, and we've rebranded. You've noticed our new logo for Planning Alternatives. It really has been exciting to introduce this new look through our website and various collateral materials, and encourage you to go to the resource section of our website. And Amanda just brought that up. And under resources, you'll see our market insights. Thanks to client input, we publish our weekly market update with perspective about what happened in the week and just tips and guidance on how to maintain a long-term strategy, but also be attuned to what's going on in the world within the week and within the quarter. Thought leadership on a variety of topics. We actually just published an article on having transparent conversations with family members about wealth. And we've begun a number of what we call family meetings over the past couple of years to help families have dialogue about how to plan for wealth transition, or if parents have health or incapacity challenges, how to navigate that as a cohesive family. Our quarterly newsletter is our Thrive report, and we've now posted those online, as well as tax resources, podcasts with wonderful guests, and that's the Day in a Canoe podcast, and then events. So we always are looking to host events that give value to you. And if you have any topics that you would like to hear more information about, we welcome your input around that, because it's really your input that guides what we do with our work. And we're so appreciative of the relationships that we have with you. So encourage you to check out our website if you haven't had an opportunity already. And we will be posting this, a recording of this webinar as well, that will be available to you all. So once again, great appreciation and gratitude to you, patients, to you, Jeffrey. Thank you for investing the time and sharing your insight and perspective with our audience today. And thank you for all that you do in influencing and guiding your circle and continuing to move forward. We are back to better, and maybe we're stuck here and there, but if we just have perspective, if we take tune into what the numbers are saying and what our heart is leading us to and combine those, that's going to be a great way to keep moving forward. So thank you, everyone, and wishing you a great remainder of the day and great remainder of the week.